We launched 4 years ago at seed. We already have 2 unicorns and it's just starting. Not bad. So not surprised because the algo does what it was trained for, but still amazed a little bit. What is magic is the last agents, Da Vinci and Raphael. That was a little bit of a surprise because it evolved. We started building it back in August. Today it's 12,000 lines of code because the embedding models have evolved, because the LLM models have evolved, because we have optimized the RAG with all the new techniques. The output is really magical. You throw a deck, a description, and the transcript of a meeting. And honestly, I'm not sure that you could have a junior analyst of that level today. It's just the beginning because the knowledge base will evolve every day. And we're looking forward to the next orthlieb model, which is going to be better.
We've made a full demo to Emergence, our first LP. Romain was demoing Da Vinci and Raphael, and one of the GPs under his or her breath went, oh shit. That same person also told us at the end that if they were starting a fund today, they would be doing exactly the same thing.
Ben, Romain, welcome to the Slice Pod, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You are the founders of Blue Moon, a pre-seed and seed stage fund that developed a machine learning algorithm to source companies and identify exceptional founders. Let's begin where we always do around here by asking, how did we get here? Was this always the plan to replace human investors with AI?
Ben and I met 10 years ago in San Francisco. We always thought there's something weird with the venture capital industry. VCs, investors, mostly work at Blue Bottle Coffee, meeting with funders in real life and working on spreadsheet. We never stopped talking about the fact that probably the people who invest in tech should use a little bit of tech themselves to perform better. That's how everything started.
Ben, like your career, I think primarily deep into B2B SaaS, right? And
right.
Romain is the French diplomat, the institutional investor. How did you build what is essentially the fund today, which is just the two of you, but augmented by a lot of code behind all of it?
When I was at LinkedIn around 2018, 2019, I did work with Reid Hoffman and the data science team to evaluate signals in the LinkedIn data for venture success. The answer was yes, there are signals, but LinkedIn only looks at aggregate data for privacy reasons. There are signals, but only aggregated at the company level. Nothing was predictive before Series B, which held true the old saying that at the early stages, what matters most is the founders. The second piece is we became scouts for Emergence Capital, working closely for Jason Green, one of the co-founders. Back in 2020, if you look at the data, the top 40 to 50 investors at early stages do about 20% of the volume of seed and Series A and capture 70+% of the unicorns. If you're building a portfolio, you need to be co-investing with good investors. You need to be investing with credible investors in credible deals. And if you do that, you actually need to invest in a lot of them. The venture game is a game of time and is highly ineffective. The idea that the network is your number one source of deal flow is pervasive but ineffective. Sure, it will help if you're in the Bay Area and you will find interesting people through the network. But you also set up so many meetings 5 minutes in, we don't want to invest. However, somebody made an intro and you're trying to stay polite for the rest of the 25 minutes. We started using machine learning to screen founders. The bad meetings went away. We now call Agatha our sourcing and screening algo. You want to feed Agatha as many data points as possible for people that could be starting new companies. Ultimately, you have an algo that helps you spend time with the best potential founders. We started automating. We started getting a lot more deal flow, started investing faster. And so Jason Green comes back to us asking why we're doing more scout checks than the rest of the Emergent scouts combined.
Jason said, hey guys, what the fuck is going on?
In a polite Jason way, but basically what he meant.
In a very polite Jason way, correct.
He was like, now I'm convinced you're crazy, but it sounds interesting, so I will humor you, keep going. We reloaded as scouts. Jason met some founders and agreed they were high quality. Our first LP meeting was a partner meeting at Emergence to pitch the idea of launching Fund 1, the concept fund to build a firm with tech, automation, and AI at every step and proved it works. Today, 4 years later, we've built the vision. We keep iterating daily, but we have AI tools supporting our human decisions at every step. At this point, we're a top 1 or 2% fund based on TVPI and a bunch of other metrics for our vintage 2021.
There's a 2024, 2025, the agentic economy, yada, yada, yada. The headlines write themselves. You're not the first emerging fund we talked to that has built agents to help within their workflow. And I don't think you'll be the last. But what is special about the orchestra of agents you brought together?
There's many different ways we can start. Hopefully at this point, we're still the only or close to the only that actually has AI across everything. There's people that do things mostly on sourcing. In fact, we help a number of funds with that, and we can come back to it. We think what we've built is different because it is at every step and built around very clearly our conviction and our process. The first step is Agatha, which is our sourcing and screening agent. Agatha uses many different data pipelines to identify 8,000 founding teams every year that look like founding teams in B2B seed North America, meaning what we do. This is a lot more deal flow than any of the established funds. Agatha helps us screen those founding teams down to about 400 that we should engage and spend time with. Agatha's job is done. Da Vinci, our AI VC associate, analyzes what the company does and gives notes, articles to share opinion and sources to dig deeper. From the first description of what a company does to then getting the deck and analyzing the deck, getting the transcript of our conversations and analyzing further, Da Vinci continuously refreshes to sharpen the analysis, give us more source, and effectively an analysis of what the product strengths are, potential challenges, diligence questions can be. All of this helps us with the traditional VC analysis, but ultimately, while the fund is AI powered, it is also about humans. The ultimate decision is a non-tech meeting, which is all about the founder and the founder stories and their personalities. And then finally, rest of the processes is also automated. So we have Bloomberg, for example, which is our tool to help coordinate and share deal flow with the top 50 funds in the US. We have a very high social capital and very good relationship with a lot of other funds because we collaborate by sort of strategy. So you've got Bloomberg, you've got Kojak, like the inspector from the 70s, which is our tool for keeping track of what's going on in the portfolio companies through their updates, through conversations we have with them. And then underneath all of this, the agent that coordinates the whole deal flow is Slash, like the guitar player, which is one of Romain's hero. And because we're both guitar players, made sense to start with a guitar player. I think that's the list. I don't think I forgot someone or an agent.
Wasn't there Raphael?
Raphael is Da Vinci's brother.
There you go.
They're both built on the same infrastructure. Raphael is effectively a chat GPT for founders, focused on early stage industry and company analysis, and early stage founder advice, which we share with founders and extended friends of 212.
What Agatha does, it's that it ingests data on each co-founder, basically what experience they have, what education they have, and their personality, inferred from everything they said and wrote publicly. Could be an interview on YouTube, a blog post, social media post. No other firms do that. And the output is a score from 0 to 100. And what it does is that it predicts the chances of the team to raise a Series B.
Why Series B?
Because the algorithm, which is pure machine learning based algorithm, was trained on the fundamental question, what are the chances of that team to raise in the future at least $20 million?
It makes sense for two reasons to train the algo on this. It creates more data points. You don't have to wait 10 to 12 years to know what the ultimate big success looked like. And then it goes back to this point that we talked about earlier, which is there are phases in the life of a company.
For example, Da Vinci, Ben was mentioning, it's a RAG, which means that Da Vinci sits on top of a huge knowledge base. Da Vinci has the capability to learn from qualified sources. Think of research papers at Stanford, MIT, all the blog posts written by the best scientists, the best investors, all the interviews of the top founders, CEOs. We have a huge knowledge base that increases and refreshes every day with high quality sources. When we say DaVinci can analyze a deck, a description, the transcript of a call, the transcript of a meeting with a founder, think of it's as if, I would say, not really Marc Andreessen, what Marc Andreessen would think of this company, but at least DaVinci knows everything that Marc Andreessen said. He doesn't know what is said privately, for sure, but everything that's said publicly, DaVinci knows it. So it's different from dumping a deck into ChatGPT, which is fine, but because it's a RAG and because it sits on top of a living knowledge base that is better improving every day, the output is just 10x, 20x, 100x better.
In fact, when founders use Raphael, they compare to ChatGPT and they prefer Raphael's answer 80% of the time. We're a tier 5 OpenAI user. One of our highest costs is tech. Zapier called us 6 weeks ago to pitch their roadmap. We cheer when ChatGPT cuts their costs and rolls out new models because our costs go down, but our capabilities go up. Once you have the infrastructure in place, it's not as easy as flipping a switch to go from O1 to O3 mini that's coming, but it's doable. Every time there's an upgrade, the skills of all our agents upgrade with it. Over the last year, if you compare the answer from DaVinci 6 to 8 months ago, which were already good, to where we are now, the firm has made incredible progress. It's like we hired an intern who became a principal in 8 months.
It's the two of you, right?
Yes.
Nobody else.
Yep.
Where did you learn how to build this kind of products? Ben, your background is in M&A, right? And Romain, you're an institutional investor by trade. Like, did you just like sat down on a Saturday, like, opened up ChatGPT and one string at a time, stitch this with that? How do I do it?
People actually thought we were completely insane. The ChatGPT moment was super helpful to us because people started to believe, oh, now I can see what you can do with AI. Before that, people, just like Jason Green, really thought we were completely crazy. Maybe I'll let Romain give the full answer. I am a Master's of Science in Engineering back in France. I was coding neural networks in 1998, then moved to finance, strategy, and M&A. Hopefully that means I do have a bit of that mindset, even though the mastermind behind all of this is Romain, so I'll let him speak.
We started in 2020 with % of the systems. The core algorithm, Agatha, we didn't build it. It was built by another team that dreamed of building a VC firm. This team is a silent partner, but today Agatha is ours. We have the IP, we own it, but we didn't build it. The rest was mostly no-code stuff using Zapier and other tools. 2 reasons why we started like this. 1, we are not engineers. Ben is an engineer, but we are not developers at the time. And 2, we had to go fast. When you use tools like Zapier, you can build quite amazing automations and magic super fast. You have to learn how to use those tools, those software, which I did. But if you are highly motivated and you're okay spending all your weekends, vacation, everything on this, you learn pretty fast. And then ChatGPT, Claude were born and changed again. If you're motivated, you can code amazing and complex software with those tools today. They can do 90% of the whole code, and you end up with 10% of bugs and this kind of stuff. So I learned Python as well, just to understand what I was doing.
I think there's a question of mindset. We've always been of the mindset of trying to automate as much as we could, which started with low-code tools like Airtable, Zapier, etc. 2 of us are GPs, and we keep what we call pulling on the thread. I don't know if we would start exactly where we started if we were to start today, because you already have ChatGPT. But if the mindset is we can automate and augment no matter what the tools available are, that's what we dug deep into. Romain, within 6 months, was contributing on the Airtable and Zapier forums, learning from them, but also helping other people out, which is exceptional in terms of the ability to retain this. When we talk to VCs who are now trying to do sourcing with data, a little bit of AI or decision rules, It's not the GPs who are doing this and redesigning their processes. They're asking their IT guy to build sourcing, which is sourcing is actually the easiest because it doesn't change your processes. We're part of groups on data and AI in venture. We pitch our products and share ideas with others. One of the challenges is a lot of those teams are not the GPs, have other jobs that keep getting over prioritized. This mindset that we had from the get-go, which is we write as little emails as possible. I reach out to founders in literally 10 clicks, from finding them to having the first meeting. We have a 75% conversion rate.
Can you explain how Da Vinci intervenes when you reach out to funders?
When I do a cold email, the cold email effectively says, hey, Fabry, Sunwoo, Agatha, our AI, found you and thinks you're very high potential founders. I'd love to learn more about what you're building. Da Vinci, which understands what you are building, is already drafting a couple of cold email questions that are highly relevant to your company, whether on any sources we can find, your website, other places that talk about you and your industry. It looks like we're already working on your company, doing research on your space. I review the questions, make sure they make sense, and send that email. I do that prep work a few days ahead of a meeting when Da Vinci generates a list of questions I should be asking you with sources for me to start getting smart on your space. That change led from a 10% cold response rate to a 40% cold response rate. And when I mean response rate is conversion to a meeting, not just, hey, great email.
You kind of like talked about this a little bit, touched on it. The fact that people thought you were crazy when you first started. As we sit here and talk about it, I would think you were crazy too if I didn't do my own research in your data room and prove this is 100% real, 100% true. You've deployed 15 million so far this way and achieved the top decile performance. And we're still like, within 3 years deployment window of the fund. So we're not even getting started yet, which is insane. How did you raise the first round of capital? Did your early LPs understand that was the product they were buying?
First, hats off to Emergence Capital because they anchored Fund 1, thanks to Jason, but the whole team. Of course, we're super, super grateful to them. They were the first to believe not only in us, but also in the system, in the vision. So to your point, they were the first to believe that could be the future, or at least that could be super interesting. First and foremost for them, they wanted to get some deal flow. And then for First One, we had a long tail of entrepreneurs, mostly tech entrepreneurs. Tech entrepreneurs are a little more visionary than others, and they use tech for themselves. They understand that, it could be a thing. They also understand that it makes sense. We use software for our customers. Probably investors could use software as well. They are not different from any companies. It's a different business model, but it's still a company. We also had a couple of family offices, very visionary, who decided to back us because they believed in what we said, or at least they wanted to go along with the experiment.
The premise was people in venture are going to take an approach that looks like D.E. Shaw, those kind of people 30 years ago. That was part of the vision that the finance people liked most. The operators liked our approach to value add and just generally using tech for venture.
I want to talk about the human side as well. What happens now? You build it. How do you scale it? Do you sell it? Do you use it for your own good? This is not a fully automated venture firm. There is a real human component of the model, which is a behavioral interview conducted by you guys, formulated on a number of questions that dig deep into the early formation moments of the individual and how those reflect in their great passion and overall chances of achieving success. Let's talk about that interview, which is 50% of the process when it comes to the human interactions that the founder has with the firm, right? There is one, which is sort of like a screening interview, and then it goes straight into the behavioral. And then 12 hours later, you promise a thumbs up or thumbs down on the investment.
We do 2 Zoom meetings with the funders and give them our answer the next day at 12 p.m. Pacific time. The first Zoom is all about product, market, competition. The second Zoom is on something different. But Ben, you wanted to say something first.
What we're looking for is effectively 5 things. The question of catalyst or trauma, a deep need to prove oneself, vision that they have a structure to pursue, grit, tenacity. Those are the four that we test for every single one of them. And then, of course, team dynamics. But Romain is the master of articulating that meaning.
One last element, if you reverse engineer, the big winners always have founders with some specific mindset, which is some sort of trauma or at least a chip on the shoulder. It's irrational to be a founder. It's a long, painful journey, and it's not like a 6-month journey. You're in pain for 20 years, 15 minimum. It's really not for everybody. So what we need to do as seed investors is understand where the motivation comes from. What is the chip on the shoulder? But most importantly, where does the chip on the shoulder come from? For example, if you ask a founder, what was your toughest, hardest moment in life? And the answer is, I had a C in college. It's not something that will prepare you for a tough life, because funding a company up until after the IPO, actually, it's going to be a little bit harder than a C in math. So we designed this second Zoom with the entire team, all the co-founders, not only the CEO, that's just for the Zoom one. And two, we prepare the meeting. So we send all co-founders, we send them some questions related to what happened in their life, how they feel with past failures, how they feel about past successes, and why. This helps us prepare for this Zoom. And then we dig deeper. We want to understand where they come from, their family, if they have siblings or not. For example, if you have siblings, if you're the oldest one or the youngest one, or if you're in the middle, it's not the same thing, usually, in psychology. It can have an impact on how you behave, on how you think of your own role in the family, responsibility or not. Sometimes the conversations are more difficult. I cannot reveal stuff, of course, but some founders have very difficult health or hard relations with their father, and some stuff happened in their past, which to us is very interesting. Sometimes nothing happened, and the Zoom is pretty flat, a little bit boring. In that case, we don't invest, but that's what we do. The interesting learning here is that 100% of the time, every time we had this kind of conversation, a long time about what happened when you were a kid, at the end of the Zoom, 100% of the time, founders tell us, hey, it was fantastic. Never talked about my father like this with anyone, and especially with any investors. So of course, with us, what is at stake for them is different from talking with Sequoia for a $20 million check. We don't cut that money, that kind of check. So they are a little bit more relaxed with us, but still, they love it. So usually we have very interesting conversations, and we learn a lot about themselves.
And maybe to your question, Fabry, on how we got there, it goes back to our belief that 90% of what matters at this point is the founders. We had this second meeting, and we've iterated with coaches, with psychologists that work specifically with founders. And it turns out, if you look at the literature, those things we found are very similar to things that help predict Olympic medalists. It's all about sort of extreme human performance. It's just applied to entrepreneurship versus pick your favorite sport. But it turns out all the frameworks for one really apply to the other.
We see a lot of emerging managers these days. They don't come from an investment background. They come from an operator background. They are a founder. They are an early employee. They realize that that's not their path and they want to do something on their own. They all have something in common. What's been your struggle so far?
Ben and I usually talk about world domination. We want to be the best seed fund in the world, period. We're not building this because it was trendy to become a VC. We're doing this to prove that we can be number one in what we do. And we will be number one in this. Ben and I, Ben a little much more than me. A lot of GPs come from that world. They're US citizen, went to Stanford, worked like 10 years as partner at Accel or whatever, and then become an emerging manager. And it all makes sense. And they're struggling, probably anyone else, but at least in terms of branding, they look like already US GPs, Silicon Valley style. We don't. We come from France. We were not partners in top US VC firms. So it's some sort of ETs entering that world that we want to dominate at our level, of course. That's the struggle.
Yeah. I think we're deep past top 5% benchmarks according to Carta. So now it's coming together, but it's been 4 or 5 years of telling the story, and hats off to Emergence to believe in a different approach with people that don't look like your typical story. If you go back 5 years ago, it's so much easier to tell the story of, I was at Twitter. I can source early entrepreneur from Twitter. It doesn't last long. You're going to make 5 investments and then what? I have this little niche, or I was a GP at another firm. This is an easy way to raise a little bit of starting capital. Of course, if you have those credentials. A third of the funds in our vintage are already dead and we're thriving. Before ChatGPT, people were thinking, you're crazy. Since ChatGPT, people are telling us everybody else does it. That drives us nuts because we talk to those people who do it and they do 100 API calls a day. We do north of 10,000.
2 million zaps a year.
Maybe we're not spreading the word enough about what we do, which is why I think we're going to release more and more Raphael. It drives me nuts when I see articles about people that, and they're right, they're using data and AI, but sometimes TechCrunch will do an article and something that we don't even think about as a feature in one of our products, but all of a sudden it's the hot thing. And so we probably like it, but part of our story is a story of a complete underdog in this industry.
As you were going about building it, did you knew that it was going to do so well so quickly, that the numbers would follow so fast?
Great question. When we launched our science project named Fund One, we benchmarked and backtested the algorithm, of course, the one that sources and screens funders. We were pretty confident that it's working well because of the backtests. Still amazed by the results. Just for those who are listening, we launched 4 years ago at Seed. We already have 2 unicorns and it's just starting. Not bad. So not surprised because the algo does what it was trained for, but still amazed a little bit. What is magic is the last agents, Da Vinci and Raphael. That was a little bit of a surprise because it evolved. We started building it back in August. Today it's 12,000 lines of code because the embedding models have evolved, because the LLM models have evolved, because we have optimized the RAG with all the new techniques. The output is really magical. You throw a deck and a description and the transcript of a meeting. Honestly, it's not Marc Andreessen's level, but I'm not sure that you could have a junior analyst of that level today. It's just the beginning because the knowledge base will evolve every day. And we are looking forward to the next orthlieb model, which is going to be better.
We've made a full demo to Emergent. They are Anchor and historically our first LP. Romain was demoing Da Vinci and Raphael and one of the GPs. That same person also told us at the end that if they were starting a fund today, they would be doing exactly the same thing.
And what is the future then? Is it going to be like the Renaissance Technologies, like the Medallion Fund, where only if you were there from day one, you get to invest, otherwise join the line? Or is it going to be packaging the technology and making it available for all other emerging managers out there, or somewhere in between?
Over the last 60 years, venture capital at early stage was a function of time and network. You needed time to discover new entrepreneurs, talk with them, and a network to source deals. The future is seed investing will not be a function of time and network anymore. Human in the loop will remain essential to assess psychology. Can it be replaced by a machine? We have an idea of a new agent called Freud, but we're not there yet. Talking about understanding, analyzing their psyche. I think it's still the job of humans to do that. The future is human GPs augmented by machines. Every day is just 24 hours, of course, but you can focus your time, which remains your limited resource, with the best funders, and then you can really dig into their psyche and the real stuff that matters. Everything else can be prepared by the machines. That's the future of seed investing.
You need the humans in the loop to win the deals. Even at our smaller side by strategy checks, you can't win deals without really establishing a value prop for the founders and a connection with the founders. If you were to think of an automated model, how do you get into those deals? It's impossible. You need a brand, but by definition, you're an emerging manager. That is impossible to do without firsthand conversation and developing a rapport with the founders.
So what you guys are saying is that technology-wise, this will be table stakes. There is no need to outsource it because everybody will build a flavor of their own.
You're seeing the trend. We're not the first ones to talk about it. The big brands don't really need tech now. They will in time, but they have time because honestly, they're only getting bigger and every founder wants to work with them. The top 5 premium brands are likely to only keep winning, which is what you've seen the last 5+ years. Everybody in the middle is struggling because they have too much money to deploy, and VC is a function of time and the number of meetings. They have to deploy big checks. And for them, it's a struggle because they lose or take the deals that Sequoia, Benchmark, Excel, A16 didn't take. And then you have to choose, all of a sudden you have to choose in a pool, you have success in there, but it's a much harder pool. The emerging managers will apply some tools, but it's hard because your means are limited. We are obsessive about this idea of automation and building a larger firm. What's interesting is more people coming from the venture world. That's where we found our closest proxy, Coatue. The fact that a hedge fund is actually applying something very similar, focused on founders, industry analysis, co-investing with signal funds, aka adverse selection. That's a great validation. But I think that's where, going back to your question, is going to be more about what do the top funds do, and do they get more competition from the likes of Coatue that already existed at growth, it's starting to exist at early stage. There was a recent article by Ben Thompson about the uneven adoption of AI. And the point, which is, as every wave of technology, if it changes processes, tools, and people, the people who are going to apply it are the people that grow into it. Because it's going to be very hard, and we're seeing it with funds that we work with, to prioritize and convince their GPs to change their processes. A lot of people, in my opinion, will adapt some tools, mostly sourcing, because that's easy. You get an extra analyst that screens all of this, and then you literally throw it to the garbage, is what most people end up doing. But actually having end-to-end is going to be hard because it's really a change, transformational.
As a competing manager, I will not be able to buy Agatha for $600 a week.
No. Sorry. Honestly, I get your point, and we have the questions like twice a day. But we would have to make it a real product. Right now, it's designed for ourselves. It's inserted into our workflows. To sell it would require more work to repackage, redesign it. Honestly, we already have quite a lot of work too. We're not sure that there would be a market for it. You would buy it probably and thank you, and you would be very happy with it. But it's classic dilemma, which is, for example, you want to sell Da Vinci, and within the firms, the analysts and principals are like, oh, I don't want to be replaced. So now I'm opposing this tool. I don't want to be replaced by software. You would have a lot of resistance in the market. A lot of GPs still believe, I've been doing this work for 20 years. I'm very good at pattern recognition. And 25 years ago, I invested in Google. So let me do my job. It's hard for them to believe that they could be augmented by a machine. And we're not sure there would be a large market, large enough for us to do a business with it.
Which is funny because machine learning is all about pattern recognition.
Absolutely.
Maybe extending on that, we do monetize it in an indirect way. Our LPs have access. We work with other GPs that ask us to score their deal flow, which means we have access to their deal flow. We collaborate with a lot of other VCs because we're a small check. We don't compete with them. We need to have the presence of a first round, of an emergence, of a NFX, a foundation capital on a round for us to exist on that round. Because we generate a lot of deal flow and share that deal flow, we establish great relationships with a lot of the top VCs. And so our monetization is ultimately social capital with a lot of the top funds through deal flow sharing.
Meaning that the only way forward is more funds, and you're now raising your second one. What is different about Fund 2 relative to Fund 1? Like I mentioned that it's twice the size. You're going up to 30, if I remember correctly.
That's right.
And what else besides sheer firepower is different about this vintage?
One, initial checks would be larger, twice the size. Initial checks with Fund 1 were 100K, really this time 200K, 250K. There will be reserves this time. Most importantly, that's the technicalities of the fund and the fund model. Okay. Now, if you compare with Fund 1, two things. We raised the bar of selection. Agatha spits out a score, and when we started with Fund 1, we looked at all the companies above the threshold. Now the threshold is really high. That's difference number one. The agents have evolved. We have much more firepower in terms of sourcing deals, vetting deals, this kind of stuff. That when we started, we saw 3,000 deals a year. Today, it's 8,000. So more deals at the top, but higher threshold, which means same number of first meetings. But the quality of those meetings, on average, now has jumped even higher. The second difference is we learned a lot of things. We learned how to better analyze psyche of funders. Every GPs learn. It's a long cycle.
Maybe in that learning, just to, we've seen in the span of 4 years, but really 2, because of when we invested in those 2 companies, we've seen in the span of the last 2 years, companies go from basically seed to being unicorns. That's a threshold. We've also backed 7 teams out of 50 that have already built and sold a unicorn. So in many ways, that benchmark has been set, right? It's the same way that Agatha, because we can source way more, we've been able to raise the bar on the minimum score. We now have worked with and invested in those monster founders that have had unicorn type exits that become the benchmark for how we analyze companies and founding teams.
And today we have all the agents. Fund 2 is fully loaded with experience, knowledge, and agents. That's the difference.
Da Vinci was born in June. Romain and I were on the phone talking about how we can generate interesting content for LPs and founders based on what we already do from Da Vinci and Raphael. This example is innovation at the margin because we already have that infrastructure. But I think it's the DNA of how we've built the system and how we continue going, which is keep iterating. The number of things we've tried and failed and moved on is also pretty crazy. But as far as the fund is, we've tons of learning, everything is in place. And frankly, it's a machine right now.
These are things that we've talked about in our first meeting. This makes perfect sense from an LP perspective, from a manager perspective, from a deployment perspective. I get the friendly intimacy that you develop with the founder. It goes a long way in the selection process, but the check sizes are very tiny. You're not necessarily leading these rounds. You're just tagging along. The relationship and the value add that you can offer to the founder beyond that first initial capital. It's, of course, a bunch of intros to the friendlies that you work with and a bunch of agents that are helpful. It's not the traditional venture model of getting your hands dirty, jumping in with the founders themselves. Go for it, Ben.
From the get-go, because that's in Fund 2, but that was already in Fund 1, we thought about this as a product to the founders. Our process for the founders is the name of the firm. We pay for services to help the founders. Between the help through the services we pay for and the help we can do because they know we work with top VCs, we get outsized allocations in Series A. We had to do it through SPVs before, but the package works, not only in getting into 96% of the deals, but also in getting follow-ons. To be very clear, we compete with angels. Most angel, I'm available and I'll help you. Turns out Emergent's starting to try working with scouts like us because they started like a lot of scout program with CEOs of startups. Turns out they're too busy. They don't have the time to jump on the phone. And that's something we wanted to make sure we had. We put together a package of service. Our 2 main costs are services that we pay for founders and tech. Those services include an executive coach that has 3 exits, sales coaching and support, and a program for mentorship for the CTO and the early employees. They love these services. It's very helpful to them, and it's at the core of what it takes to go from seed to Series A. Most of the founders tend to be from tech side, product, or R&D. They'll figure out sales, but if they figure it out 6 months faster, that's how much value you've delivered to every other investor, but most importantly to them. That's part of our package, and that's the rational reason. There's the intimacy and the fact that they like that we venture more like founders with tech. That's the soft reasons why they take us on board. But the hard reasons are we pay for services and we have a very clear value prop that they don't see anywhere else, at least for our size check.
There's a very founder-like approach to a problem. You're solving naturally you wouldn't be able to do. So one of the number one things that we push our emerging managers on is like, this sounds great. your value add. This is your first vehicle. You have 15, 20 companies. It's awesome. But like, once you're going to have like 200-300 companies, how is this going to work? You already know it. So we're like, we'll outsource it from the beginning because there is no way that we can actually take care of it.
And we have 50 companies in the portfolio, and it works. Yeah. So it's going to be easy to scale.
Guys, thank you so much for doing this. It's getting dark here in California. When we started, it was a wonderful sunset, but time flew by.
Thank you, Fabrice. Thank you, Sunwoo.
Thank you.
Thank you both.
Ciao.
You've just listened to another episode of Slice Season 2, the podcast for emerging managers. Special thank you to Ben and Romain for joining us for the conversation. If you're new around here, welcome. Make sure to subscribe to our Substack not to miss any future episodes. We'll see you then. Bye.